Welcome to the HMO Property Show. By investors, for investors. Catch us weekly as we discuss all things cash flow positive property investing. Whether you're a seasoned investor, a new landlord, or just curious about property investing, this is the podcast for you. Sponsored by the Co-Living Collective, your trusted partner in creating vibrant and sustainable shared living experiences. Visit us at colivingcollective.com.au to learn more.
Welcome back to the HMO Property Show. I'm your host Neil Gibb, as always, and today I want to talk about compound interest, the eighth wonder of the world. He who understands it earns it, and he who does not pays it. That's from my good friend Mr. Albert Einstein. Now, the reason I want to talk about compound interest today is because we've been doing quite a bit of work in the background to help our clients not just see what the HMO is doing today, but also what the HMO will do in the future, in the next 3 years, 5 years, 7 years, 10 years. And we built out a model where we can put in annual room rate. So I've got a thumbs up on the camera there if you're watching me on YouTube. It will increase room rates by a certain percentage per year. You can do 3, 5, 10%. Put capital growth in there at a certain percentage every year as well. And you can start to see how over time, if you use the cash flow to pay down your principal component of your debt, it will show you how you can increase your net worth twice as fast than if you just invest in a standard investment property. Because if you've got a standard investment property and you're not paying down the debt, then your wealth is only increasing at the rate that the market will increase. But if you're also reducing your debt component and you want to bank less money, then that means your wealth is also increasing again because your net worth is increasing. So here's a question for you. Would you rather have $1 million today, or a cent, or a penny, depends where you're listening to this podcast from, cent, penny, or any other nominal figure that doubles every day for 30 days? $1 million today, or a cent that doubles every day for 30 days? Now, when I first heard this question, I was like, $1 million all day long, because it sounds like a really easy choice. However, if you choose the penny or the cent, by day 30, you'd have over $5 million because of that compounding effect of it doubling and doubling and doubling. So it's 1 cent, 2 cents, 4 cents, 8 cents, 16 cents, 32 cents, 64 cents. Don't test me. I can keep it going, but you get the idea that over time it continues to increase and double and double and double. And before you know it, you've got $5 million within 30 days. It's just an incredible tool that once you understand it and once you see it in action, you can understand how it works. And Benjamin Franklin once said, it's money that makes money, and that money then butchered it. I've absolutely butchered it. Sorry guys. Money makes money, and the money that money makes money. Money makes money, and the money that money makes money. It just continuously compounds on top and on top, and it's very rare that you're going to get something that doubles in value every day. But even in small nominal figures like 5%, then property values can increase substantially over time. And I'll talk about Warren Buffett soon, because he's probably been the most vocal and also experienced probably some of the most impactful compound interest that the world has ever seen. And I'm going to go through his numbers soon. But if you've got a property that's worth $1 million and it sees capital growth of 5%, then at the end of that 12 month, your property is worth $1,050,000 because the 5% interest increased the value of that property. Now, the beauty of it is, if, let's say, for instance, the property market continuously increased at 5% over and over and over again, which it's unlikely, very unlikely, because it fluctuates up and down, but just go with me. So if you, in year 2, your property, you would make $50,000, so your property would be worth $1,050,000. But then you're making 5% on that $1,050,000, which means in the second year, you would make $102,000. So your property would be worth 1.1 and 2,500. Then you're making 5% on that figure. So in year 3, you are making $157,000 in interest. Year 4, you're making $215,000 in interest. And by year 5, you've made over $276,000 in interest, and your property has gone from $1 million to $1.2 million, almost $1.3 million, because over time it's increasing in the percentage of what the market moves by, and it's the value of the property, not what you paid for the property. So in the financial freedom blueprint which we've created, the model that we've created for our business, if you purchased a HMO and the capital growth, let's say for instance, is 5%. Now last year Perth seen 20%. Is that, it's a bit of a wild figure. You're not going to get that every year. We have seen 9% this year from January to May. However, we're not going to get that all the time. So just being realistic, 5% capital growth per annum, and I put 5% increase in room rates per annum in there as well, which means from year 10, or in year 10, when you first rent the property out with $350 per room, your gross rental income will be $109,000. By year 10, with the power of compound interest and 5% room rate increases every year for 10 years, your property will be renting out for $161,000 per year. That's a $50,000 increase by doing absolutely nothing apart from the property management team increasing the room rates. Now, the benefit of that in terms of property value would also mean that your property's gone up from $983,000 and 5% capital growth per year. By year 10, your property would be worth $1.446 million. Now, the beauty of that is, because of your equity in the deal that you put down there in the first place, plus the cash flow that you've been making, by year 10, your equity would have increased by, or your equity position would be $883,000 by 10 years. And you'd have paid down your debt from 80% to 37% by using the additional cash flow to pay down your debt. So your property's gone up in value, the debt has decreased in value, and your net worth has increased substantially. That is the power of compounding interest. I'm going to find it again. Money that makes money, and the money that money makes money. Powerful stuff, especially when you've got cash flow and capital growth in the same deal. Makes a big difference. So there's actually a formula that I found for compound interest, right? And I'm going to try and explain it to you. It's a difficult one. So the formula is A equals P, open bracket, 1 plus R slash N, close bracket, is higher than, open brackets, NT, close brackets. Did you get that? So A is the amount of money accumulated after N years, including interest. P is the principal amount, and that's the initial sum of money that you put in there. R is the annual interest rate. N is the number of times that interest is compounded per year. And T is the time the money is invested for in years. So I'll run you through it again. A equals P, open brackets, 1 plus R slash N, R divided by N, sorry, close brackets, is higher than, open brackets, NT, close brackets. Hope you got that, guys. Did you get your pen out and write it down? So even in smaller denominations as well, I know we're talking about $1 million properties and stuff like that, but even if you just invested $1,000 into a interest-bearing account that got 5% compounded annually, not just 5% from the bank, after 10 years, your investment would grow to approximately $1,628. Now, not massive money, not life-changing money, but it's better than your $1,000 that you had before. And as long as that compounded interest rate is higher than inflation, then you're still making money. But if your interest rate is lower than inflation, then inflation is actually chewing away at the power, the buying power of your dollar. So you're actually losing money if your interest rate is not higher than inflation. That's why it's always good to have some money parked in property that goes up when inflation's kicking around. So, as I said earlier, I'm going to talk about our good friend Mr. Warren Buffett. He started investing in a very young age, and he allowed his investments to compound over decades. And when I say decades, he started investing when he was 14, and now he's 83 or 84. And Warren Buffett says, my wealth has come from a combination of living in America, some lucky genes, and compound interest. So I won't go right back to when he was 14, but when he was 35, he was worth 7 million. When he was 40, he was worth 34 million. When he was 45, he was worth 63 million. When he was 50, he was worth 350 million. When he was 55, he was worth 1.4 billion. When he was 60, he was worth 3.9 billion. When he was 65, he was worth 17 billion. When he was 72, he was worth 36 billion. And at the ripe old age of 83, he's worth 58 billion. Now, Warren has built a lot of his wealth by investing in funds that have generated, on average, 20% per annum compounded over years. Now, he's made more than that, he's made less than that, but on average, his investments generate a 20% return. That's pretty outstanding, isn't it? No wonder he's one of the richest men on the planet, behind Jeff Bezos and Elon Musk, and God knows whoever else. But even if you just start saving $200 a month at the age of 25, and you can find something that gives you an average annual return of 7%, by the time you retire at 65, you'll have over $500,000. That's not too bad. So your super fund should return you 7% per annum, right? So between the ages of 25 to 65, not too bad. Let's be honest, $200 a month, $1,000 a year, $1,200 a year. It's not too bad. But the key takeaway here is the importance of starting early and being consistent. Just like our good friend Mr. Buffett, he started early and he was consistent. He's probably put small regular contributions into his investments and just compounded it over and over and over again. Now, whether you are in stocks, bonds, real estate, the principle remains the same. The longer your investment compounds, the more substantial your returns. I like real estate. I've got a few shares, not that big on them. I've really just invested in them because people have told me to. I'll be brutally honest. Someone said, put some money into this. I haven't got a massive amount of money into it, like 10, 15 grand max. But it was money that I thought could be worth putting in there. I didn't have anything else to put it in at the time, so I put it into there. And they seem to be going okay. But there is risks. Risks. The thing with compound interest is it compounds not just on principal, but it compounds on debt as well. So if you've got a credit card right now that's got 20% per annum, you know, that is, and you're not paying it off. Credit cards are good if you pay them off, guys, but if you let the interest rate build up on them, they just end up costing you more and more money. But it's equally important to understand how compound interest can work against you when it comes to debt. When you borrow money, whether through a credit card, student loan, or mortgage, compound interest can significantly increase the amount you owe over time. So an example would be, imagine you've got a credit card balance of $1,000 with an annual interest rate of 20% compounded monthly. And if you only make the minimum payments each month, the interest will compound and you'll end up paying much more than the original amount you borrowed. I don't know if you've ever looked at the bottom of your credit card statement when they send out the bill. And let's say it says like you owe $10,000 and your minimum payment is $800. I'm just making this up. But at the bottom it will say, if you just make the minimum payments and never use this card again, it will take you 68 years and 8 months to pay off this debt. That's compound interest at work when it comes to debt. And this is why banks are just absolutely killing it right now, right? So be warned, guys, debt compounds the same as principal. If you got credit card debt, you want to hit the highest interest debt down first. Get rid of that as high as possible. When I had some debt back in the days, 2011, 12 and 13, I looked at my credit cards and I looked at the highest interest rate ones first. To be honest, they're all very similar. They were 21, 20, 18%, but I hit the 20% at first because that's the one that was crippling me the most. Paid that down, hit the next one, before you know it, you're out. Very similar to investing in something that produces a return, credit card debt. and just compounding debt will absolutely wipe you out unless you get on top of it. So the impact of compound interest when taken on long-term loans like mortgages. Even small differences in interest rates can significantly affect the total amount repaid over the life of a loan. For instance, a 1% increase in mortgage rates can add thousands of dollars to the cost of your home over a 30-year loan. Don't we just know that? We all just experienced it over the last couple of years, right? Interest rates, I mean, when some of these interest rates had twos in front of them, it was like free money, literally like Monopoly, wasn't it? Greenhouses getting purchased everywhere from everybody because they just thought it was going to stay this cheap forever. Hopefully the interest rate comes down a little bit, even if it just comes down a few base points. I'd like to see the HMO interest rate around the 5% interest rate at the minute, but even if it doesn't, with the blueprint that we've just created there for the HMOs, we can see exactly how it's going to perform over the years with very, very conservative figures. And what I've also started noting over trading platforms and robo advisors and automated investment platforms, which are starting to pop up now in the crypto space. These things are essentially just saying like they'll make like small little scalping trades, like 1% is 0.5%, but they'll do a few of them per day for you. Compound your interest. I haven't done any of them myself, so you'd have to look into that yourself, guys. But there's also fintech innovations that are providing easier access to compounding investment opportunities. Just a few clicks and you start investing, taking advantage of the power of compounding. I am a little bit skeptical about these things. So do your own research, guys, if you are going to go down that. So just remember, compound interest, he who understands it earns it, and he does not pays it. It's from our good friend Mr. Albert Einstein. It's a bit of a shorter podcast for you today, guys, but I hope it helped you understand what it is, how it is, if you didn't know what it is. There's some cool things online. If you go to the moneysmart.gov.au website, there's a compound interest calculator. You can have a little play about with that there, and it can show you what you can do with investment strategies. If you've got an initial deposit and then you put a regular deposit into there at different frequencies, and you can say how often it would compound over a certain amount of years. It will show you how you can increase your wealth over a long time by just investing that short amount of time, short amount of money, small amount of money, and see how over a long time you will increase your wealth. It's definitely not a quick get rich quick scheme. It's definitely a get rich slow scheme. But again, time in the market is better than timing the market. Get in there, invest, sit back, and let the power of compound interest do its thing. Join us again next week, guys, on the next podcast. And remember, every master was once a disaster. Every winner was once a beginner.
Thanks for watching. Make sure you tune in the same time next week so you can stay up to date with all cash flow positive property updates.